Okay, so you know how sometimes personal finance can just feel like this big, tangled mess?
Right. With all the jargon and the conflicting advice, it can be tough to figure out where to even start.
Exactly. Well, today we're going to try to untangle all that. We're doing a deep dive into The Simple Path to Wealth by J.L. Collins.
Yeah, this is a great book for that,
I
actually.
think so too, and you sent it to us. So that means this deep dive is for you. We're going to really get to the heart of it, pull out those key actionable steps, and hopefully give you some of those aha moments.
Exactly. We want you to walk away from this feeling confident and in control of your finances without feeling like you need a PhD in economics.
Right. We're aiming for clarity and simplicity here. No jargon, just practical wisdom you can actually use.
So what if we just jump right in?
Let's do it. Now, the book starts with a super simple yet really powerful idea. It basically boils down to the fundamental equation for building wealth.
And it's so simple, it's almost like, wait, is that all there is to it?
Right. It's basically spend less than you earn, invest the difference, and avoid debt like it's the plague.
It sounds almost too easy, but the book makes a really strong case for why sticking to this basic formula consistently is the most reliable path to financial freedom.
And a concept that really brings this to life is something J.L. Collins calls FU money. Can you tell us more about that?
Yeah, FU money isn't really about a specific dollar amount. It's more about the freedom and the choices that money can give you.
So it's more of a mindset than an actual number.
Exactly. The author talks about how he achieved this surprisingly early in his career with what, might seem like a relatively small amount of money by today's standards.
Right, especially compared to what some people think of as wealthy today.
But even that small cushion gave him the confidence to do things like negotiate for 4 months of unpaid leave from his job to travel the world, which at the time was like unheard of.
Wow, 4 months.
Yeah. And, it's not just about fancy trips or anything like that. It's about having the ability to walk away from a situation that doesn't serve you, whether that's a job, a relationship, or anything else.
That makes so much sense. It's about having options, not being trapped.
Exactly. And it's about aligning your life with your values, not just being driven by financial pressures.
That's a really powerful idea. So how does J.L. Collins suggest we actually get to that point of having this FU money?
Well, one of the biggest things he emphasizes is the power of a high savings rate, like aiming for 50% or even more of your income.
Whoa, 50%. That sounds like a lot.
It can be, but it's all relative to your circumstances and goals.
Yeah.
But the idea is that the more you can save, the faster you can build that financial cushion. And it kind of creates this double benefit, right?
How so?
First, you get used to living on less, which means you're less dependent on a high income to maintain your lifestyle.
That makes sense. You're not constantly chasing a bigger paycheck just to keep up with your expenses.
Exactly. And second, it gives you more money to invest, which can then grow and compound over time.
It's like setting up a snowball effect.
Right. So it's not just about saving, but also about how you invest those savings to really make them work for you.
That's a great point, and leads us right into another big topic the book really dives into, debt. What's J.L. Collins' take on that?
Oh, he's very clear about this. Debt is bad. Avoid it as much as possible. He actually shares a great piece of advice he got from his father early on. If it sounds too good to be true, it is.
That's such good advice, especially when it comes to things like credit cards or those easy payment plans. That can be tempting.
It's easy to fall into the trap of thinking, oh, I can afford the monthly payments without really considering the long-term cost of that debt.
Yeah, and our society has kind of normalized debt, right? Mortgages, student loans, credit cards, it's almost expected these days.
It's really become ingrained in our culture. But the author makes a really strong case for why we should be cautious about taking on any kind of debt, because it can really limit your choices and create a lot of stress.
He paints a pretty sobering picture of how debt can essentially chain you to your income, constantly trying to catch up while also paying off past obligations.
Yeah, and it can create this negative spiral where you're always feeling behind, which can then lead to even more debt.
It's like a vicious cycle. So, for those of us who might already have some debt, what does he recommend?
He's pretty adamant that the ideal situation is to be completely debt-free, but he realizes that's not always realistic for everyone.
Right. People might have student loans or maybe they took out a mortgage.
Exactly. So his practical advice is to focus on paying off any high-interest debt first. He specifically mentions anything over 5%.
Okay, so that's the threshold where it really starts to eat into your potential returns.
Yeah, because if you can earn, say, 7% on your investments, but you're paying 8% on your debt, you're actually losing money overall.
That makes total sense. Now, what about those types of debt that people often call good debt, like business loans, mortgages, or student loans?
You know, it's interesting because he even challenges the idea of good debt.
Hmm.
He argues that we should be really cautious about taking on any kind of debt, even if it seems like it's for a good reason.
So, even something like a student loan to get a degree, which people often see as an investment in their future.
He brings up a really good point about that. He talks about how college costs have skyrocketed compared to when he was a student. And a big part of that is because of the easy availability of student loans.
It's like a self-fulfilling prophecy. Colleges can keep raising prices because students can just borrow more.
Exactly. And it puts a huge burden on young people starting out, especially if they end up with a degree that doesn't lead to a high-paying job. He makes a compelling argument that unlike other assets you might borrow for, like a house or a car, the value of a degree isn't always as tangible or directly tied to income.
That's a really interesting perspective. Okay, so let's move on to the heart of the book's wealth building strategy, the stock market. What's J.L. Collins's take on that?
He's a huge advocate for the stock market as a way to build wealth over the long term. But he emphasizes the importance of taking a long-term view and not getting spooked by short-term fluctuations.
So, riding out those inevitable ups and downs.
Exactly. He even says that market drops are a normal and healthy part of the cycle. In fact, he encourages us to view them as opportunities.
Opportunities. How so?
Well, when the market goes down, it means you can buy more shares of great companies at a lower price. It's like a sale on your future wealth.
That's a really good way to look at it. So, when the market dips, it's not necessarily a bad thing if you're in it for the long haul?
Right. He even looks back at historical data like the Dow Jones Industrial Average over the past century to show how even though there have been crashes and corrections along the way, the overall trend has been steadily upward.
That long-term perspective is so important. He also talks about the concept of self-cleansing when it comes to index funds. What does that mean?
He's specifically referring to broad market index funds like VTSAX, which is the Vanguard Total Stock Market Index Fund.
Yeah, he mentions that one a lot.
It's a great fund for a few reasons, but essentially self-cleansing means that as companies within the index fail or become less successful, they're automatically replaced by newer, stronger companies.
So it's kind of like natural selection for the stock market.
Exactly. The index is constantly adapting and evolving to reflect the overall health of the economy. This is also why he strongly advises against trying to time the market or pick individual stocks.
Because it's so hard to predict what's going to happen in the short term.
Right. He even quotes Warren Buffett, who famously said that an investor couldn't have lost money over the long term by simply staying invested in the market. But so many people did by trying to jump in and out at the right time. And there's a lot of data to back that up. Most professional fund managers actually don't beat the market over the long run.
That's pretty amazing when you think about it. So instead of trying to outsmart the market, it's better to just ride the wave.
Exactly. He uses this great analogy of beer and foam. The beer is the underlying businesses that make up the market, the actual value being created. The foam is the daily fluctuations, the noise and hype that can distract us.
So focus on the beer, not the foam.
Right. If you're invested in good businesses, the foam will eventually settle and the value of the beer will remain.
That's a really helpful way to think about it. Now, even if we know the market generally goes up over time, there are still going to be those inevitable downturns. The book even refers to them as the big, ugly event.
Right. Those major crashes or corrections that can be scary, especially if you haven't experienced one before.
So how does J.L. Collins suggest we navigate those times?
He emphasizes that even though they're unpleasant, they're also an opportunity to buy more at a lower price. Like if you were planning to buy a house and suddenly all the houses in your neighborhood went on sale for 50% off, wouldn't you be excited?
Yeah, of course.
It's the same with the stock market. When it drops significantly, it's a chance to get more of those same great companies at a discount. So instead of panicking, try to see it as a buying opportunity.
Okay, that's actually a really helpful way to reframe it. He also mentions that severe deflationary depressions, like what happened in 1929, are actually pretty rare.
Yeah, those kinds of events are definitely not the norm. And he actually contrasts that with the more common risk of inflation, which is when the purchasing power of your money decreases over time.
And he says that stocks can actually be a good hedge against inflation.
Yeah, because the value of the underlying businesses, their assets, and their pricing power tends to rise along with inflation.
That makes sense. So if you're worried about inflation eroding your savings, stocks can actually be a good place to protect your money.
Exactly. So the key takeaway here is that during those big, ugly events, try to resist the urge to panic and sell. Stay the course, and if you can, keep investing.
Now, the book lays out a very specific and thankfully simple investing strategy, focusing on low-cost index funds. Why does J.L. Collins recommend this approach?
Well, first of all, index funds are designed to track the performance of a broad market index, like the S&P 500 or the total stock market.
So instead of trying to pick individual stocks, you're basically buying a tiny piece of hundreds or even thousands of companies.
Right. And because they're passively managed, meaning they just follow the index, they tend to have much lower fees than actively managed funds.
So you're not paying someone to try to beat the market, which, as we discussed earlier, is really hard to do consistently.
Exactly. And those fees can really add up over time, eating into your returns. He even does the math to show how even a seemingly small difference in fees can result in a huge difference in your ending balance after several decades.
That's why he's such a fan of Vanguard, right?
Yes, especially their index funds like VTSAX and VBTLX. He highlights Vanguard's unique structure, where it's actually owned by its own funds and therefore by the investors in those funds.
So it's not beholden to outside shareholders who are demanding
But
profits.
their primary goal is to keep costs low for their investors. It's a pretty cool model.
So if you're looking for low-cost diversified index funds, Vanguard is a great place to start. Now, how does he suggest we decide how to allocate our money between stocks and bonds?
He lays out a couple of basic strategies depending on your time horizon and risk tolerance. For people who are in the wealth accumulation phase, meaning they have a long time until retirement, he recommends a portfolio that's almost entirely stocks.
So basically putting most of your money into something like VTSAX.
Right. The idea is that when you're younger, you have more time to recover from any market downturns so you can afford to take on more risk.
And as you get closer to retirement.
Then he suggests gradually adding bonds to your portfolio, using a fund like VBTLX. Bonds are generally less volatile than stocks and can help cushion your portfolio during those big, ugly events.
So it's about finding the right balance for your individual situation.
Exactly. And he emphasizes that it's not just about your age, but also your risk tolerance, your financial goals, and your overall circumstances.
Right. Someone in their 30s who is very risk averse might want a more conservative portfolio than someone in their 50s who is comfortable with more volatility.
Exactly. It's all about finding what works best for you.
Hmm.
He also mentions target retirement funds, or TRFs, as an even simpler option.
What are those?
They're basically one-fund solutions that automatically adjust your asset allocation as you get closer to retirement. So they start out more heavily weighted towards stocks and then gradually shift to a more conservative mix of stocks and bonds as you approach your target retirement date.
That sounds pretty convenient.
It is, if you want a hands-off approach. Now, another big piece of the puzzle is taking advantage of tax-advantaged accounts. Can you explain why those are so important?
Absolutely. So accounts like 401k, traditional IRAs, and Roth IRAs offer significant tax benefits that can really boost your long-term savings.
They basically allow your investments to grow without being taxed each year, either on the contributions you make now or on the withdrawals you take later, depending on the type of account. This can make a huge difference in the final amount you accumulate over time.
So it's like getting a bonus from the government just for saving for your future.
Pretty much.
Mm-hmm.
He briefly explains the core difference between traditional and Roth accounts. With traditional accounts, like a traditional 401k or IRA, you typically get a tax deduction on your contributions, but you'll pay taxes on the money you withdraw in retirement.
Okay, so you're deferring the taxes till later.
Right. With Roth accounts, it's the opposite. You pay taxes on your contributions up front, but your withdrawals in retirement are tax-free.
That's a pretty good deal if you expect to be in a higher tax bracket in retirement.
Exactly. It's a strategic decision based on your current and projected income. And there's one more detail he mentions about traditional accounts: required minimum distributions, or RMDs.
What are those?
So, starting at age 70 and a half, the IRS requires you to start taking withdrawals from your traditional 401k and IRA accounts. These are called required minimum distributions. The amount you have to withdraw each year is based on your life expectancy. It's important to be aware of this as you're planning for retirement.
Okay, good to know. Now, he also highlights another type of account that can be really beneficial: the health savings account, or HSA.
Yeah, HSAs are great. They're specifically for healthcare expenses. And what's really cool about them is they offer a triple tax advantage.
Triple tax advantage. Tell me more.
So first, your contributions are tax deductible, meaning you can lower your taxable income. Second, the money grows tax-free while it's in the account. And third, when you withdraw the money for qualified medical expenses, those withdrawals are also tax-free.
That's incredible. So it's like a super-powered savings account for healthcare.
Exactly. And what's even better is that if you don't need to use all of the money for medical expenses right away, you can actually invest it and let it grow for the long term, just like a retirement account.
That's a great point. It's like a bonus savings vehicle. Now, the book includes a really helpful case study based on a letter from a reader. Let's imagine someone who's been diligently saving a good chunk of their income. They have an existing investment account with a mix of mutual funds. Their employer offers a 403(b) with a low-cost VTSAX option, and they also have a Roth IRA. What kind of advice would J.L. Collins likely give in this scenario?
Based on his core principles, the first thing he'd probably recommend is simplifying and consolidating their investments. Get rid of those high-fee mutual funds and focus on low-cost index funds like VTSAX.
So maybe move those existing investments into the Roth IRA and really maximize contributions to the 403(b) using the VTSAX option.
Exactly. It streamlines things and keeps costs low. And he also talks a lot about the power of compounding, right?
Yeah, he loves that snowball analogy.
So if this person, for example, had received even a small initial investment from their grandparents many years ago, that money would have had so much time to grow and compound, especially if they were consistently adding to it.
It really highlights how the earlier you start investing, the better. Even small amounts can add up over time. Now, a common question people have is about how frequently they should invest. Should they put in a lump sum when they have the money or spread it out over time through dollar cost averaging? What does J.L. Collins say?
He actually prefers lump sum investing when possible.
Mhm.
The idea is that, statistically speaking, the market tends to go up more than it goes down over the long run.
So the sooner you get your money invested, the better chance it has to participate in that growth.
Right. But he also acknowledges that dollar cost averaging can be helpful for some people psychologically.
Yeah, if it helps someone overcome their fear of investing a large sum all at once, then it's still a good strategy. The important thing is to be consistent.
Exactly. Now, the world of personal finance can be tricky, and the book highlights some common pitfalls to watch out for.
Like what?
One big one is to be wary of financial advisors, especially those who work on commission or have incentives to sell you specific products.
Because their interests might not always align with yours.
Right. He emphasizes the potential for conflicted advice and the negative impact that high fees can have on your returns. Often, the simplest and most effective advice investing in low-cost index funds isn't the most profitable advice for them to give.
That makes sense. He also warns against getting caught up in the constant noise of the financial media and all the so-called gurus who are always predicting what the market is going to do next.
Yeah, he uses the example of shows like Wall Street Week, which were really popular for decades. But ultimately, trying to time the market based on those predictions is usually a recipe for disaster.
Sure.
It's more about managing your emotions and sticking to your plan than it is about trying to outsmart everyone else.
And finally, he reminds us that we're all vulnerable to scams and cons, even if we think we're financially savvy.
His first rule of not being conned is simply to be aware that it can happen to you.
That's such good advice. Now, as we approach retirement, one of the big questions is how much of our accumulated wealth we can safely withdraw each year without running out of money. The book touches on the concept of the 4% rule. Can you explain that?
Sure, the 4% rule is a general guideline that suggests you can typically withdraw about 4% of your investment portfolio's value in the first year of retirement, and then adjust that amount for inflation each year and have a pretty good chance of your money lasting for at least 30 years.
Okay, so it's a starting point, but not a hard and fast rule.
Exactly. Your actual withdrawal rate might need to be adjusted based on your individual circumstances, how long you expect to live, how much you plan to spend, and how the market actually performs during your retirement years. Flexibility is key.
Got it. Now, another big factor in retirement planning is Social Security. What's the book's perspective on that?
The book acknowledges that Social Security is an important part of the retirement picture for many people. But he also points out that there are some potential challenges to the system in the future, given demographic trends and things like that.
So we shouldn't necessarily assume it will be there for us in the same way it is today.
Right. His advice is to plan for your financial future, as if Social Security won't be there. That way, if it is available to you, it's like a bonus. But it shouldn't be the foundation of your retirement plan.
That's a really prudent approach. Now, finally, the book really emphasizes that true wealth is about more than just accumulating money. What does J.L. Collins say about the deeper meaning of wealth?
Well, he argues that true wealth is ultimately about financial independence, about having the resources to make choices that align with your values and to live life on your own terms.
So it's about having options and freedom.
Exactly. He shares a personal story about making a big donation to a cause he believed in and how much satisfaction that brought him. It's a reminder that money is just a tool, and the real value comes from how we use it to create a life that's meaningful to us.
That's a great point. So, as we wrap up this deep dive into the simple path to wealth, what are the key takeaways you want our listener to remember?
I think the core message is that building wealth doesn't have to be complicated. Focus on saving a high percentage of your income, consistently investing that money in low-cost index funds, and avoiding unnecessary debt. And always remember to take a long-term perspective. Don't get distracted by the short-term noise.
Simplicity, consistency, and patience. Those are the keys to success.
Exactly.
And for you, our listener, we hope you now have a much clearer understanding of the simple path and how you can start applying it to your own financial journey no matter where you're starting from. The goal was to give you some actionable insights and hopefully spark some of those aha moments.
We encourage you to dig a little deeper into the concepts that resonated with you. Maybe do some research on those index funds and tax-advantaged accounts we talked about.
And here's a final thought. J.L. Collins argues that often the biggest obstacles to growing our wealth aren't external factors, but our own complex thinking and emotional reactions to money. So what's one area of your financial life where you can simplify your approach starting today?
That's a great question for everyone to consider.